Hello traders, you are welcome to this video and I especially welcome you back to the Forex Geek channel. If you have been looking for a reliable and powerful strategy to improve your Forex trades, then the RSI EMA strategy might be just what you need. Combining two essential indicators, the RSI and the EMA, this strategy helps you identify trends and spot reversal points with precision. Let's just break it down step by step. Okay. Now, the RSI or the Relative Strength Index is a momentum oscillator. It helps traders spot whether an asset is overbought or oversold by measuring the speed and change of price movements. On the other hand, the EMA gives more weight to recent price movements, making it a quicker and more sensitive indicator compared to the simple moving average. When combined, these two indicators filter out market noise and provide clearer signals for making better trade decisions. Now, to start using the RSI EMA strategy, you need to apply both the RSI and the EMA to your chart. For the RSI, the default setting of 14 periods work well for most markets. The key levels to watch are 70 for overbought and 30 for oversold. Next, you apply the EMA to the chart. The 50-period EMA works for identifying short-term trends, and the 200-period EMA will show you the longer-term market direction. So, depending on your trading style, you can decide to use the 50 or the 200. Okay, so these will help you filter out unwanted market noise. Now, let's get into how to interpret the signals. If the RSI goes above 70, the market may be overbought, signaling a potential correction. And you can see that we had something like that happen around here, right? If the RSI drops below 30, the market could be oversold and a bounce back might happen. And you can see that we had something like that happen around here. Okay, the EMA helps confirm trend direction. If the price is above the EMA, the market is in an uptrend, suggesting a potential buying opportunity. If the price is below the EMA, it's a downtrend, suggesting a potential selling opportunity. So, how do you enter trades with this strategy? For buy trades, you wait for the RSI to be below 30. All right? You wait for the RSI to be below 30, indicating oversold conditions. Then you wait for the price to cross above the 50-period EMA. Okay? So this confirms an upward trend, and you can enter a long position. Enter a long position. For sell trades, you wait for the RSI to be above 70, indicating overbought conditions. Then you wait for the price to cross below the 50-period EMA, signaling a potential downtrend. You can then enter a short position. Okay? Now let's just quickly talk about risk management. Risk management is essential in any strategy. Always set a stop loss. It's very important. No strategy guarantees profit. No strategy is foolproof. So do not assume that you will be right all the time. Set stop loss so that if you are not right, your losses will be limited. Okay? So you should set a stop loss just below the recent swing low for your buy trades. Below the recent swing low for your buy trades, or just above the recent swing high for your sell trades. All right. As for your take profit targets, aim for key support and resistance levels. For your sell, you aim for key support levels. For your buy, aim for key resistance levels. Or you can use a risk to reward ratio that suits your trading style. I will recommend a risk to reward ratio of 1:2 minimum. That is, if you are risking 10 pips, your potential profit should be at least 20 pips. If you are risking $10, your potential profit should be at least $20. So that's a good risk to reward ratio. It's important to have good risk to reward ratios, okay? So that even if you have the same number of wins and losses, you're still going to be on the winning side. Imagine if you had 5 consecutive wins and 5 consecutive losses. Or maybe they may not have to be consecutive. Maybe they were at intervals. Maybe you won your first trade, you lost the second, maybe you lost the third, and then you won the fourth, you won the fifth, you lost the sixth, maybe you won the seventh and the eighth. Basically, in 10 trades, you lost 5 and you won 5, not consecutively. But at the end of the day, because you were risking only 10 pips, for each loss, you lost only 10 pips. And for each win, you won 20 pips. 5 trades means you lost 50 pips. 5 wins, 5 losses means you lost 50 pips. 5 wins means you won 100 pips, right? So at the end of the day, you still are in 50 pips profit, even though you had 5 losses and 5 wins. So that is the importance of risk to reward ratios. In case you did not understand risk to reward ratio before, I have explained it now so you can understand it. And that's the reason why it's good to have risk to reward ratios. It's good to have good risk to reward ratios. So the RSI EMA strategy is a fantastic strategy for both trend following and counter trend traders. Although if you're a counter trend trader, you should be cautious, okay? If the momentum of the trend is strong, just stay away from the trade, or you trade in the direction of the trend. All right? Because if you try to trade against the trend, when the trend is strong, you have a higher chance of losing. So it's better to just follow the trend. Isn't it a safer option? It's a safer option to follow the trend. All right? The strategy helps you to spot ideal trade setups with more clarity and confidence. Practice on a demo account first and backtest the strategy to see how well it suits your trading style. Okay, so that wraps up this video on the RSI EMA strategy. I hope you found it helpful. Don't forget to hit that like button and drop a comment below with any questions that you may have. Also, don't forget to subscribe to the channel for more trading tips and click the notification bell so that you do not miss out on more trading videos like this. In the meantime, thank you for watching and I look forward to seeing you in the next video. Happy trading.